Good day, fellow investors. My name is Sven Karlin, and today I'll discuss Harmony Gold. Harmony Gold looks very tempting at first. It has a dividend yield of 4%, price to earnings ratio of 4, extremely low for a miner, price to book value of 0.4, also extremely low for a miner. And it has liabilities of just $139 million on total assets of $2.5 billion. So practically it's a cheap, no debt, global gold miner. However, its stock price is at 52-week lows. Let's see what's going on. Is it cheap? Is it a bargain? Or it's a value trap? The stock price was almost at $5 not even 12 months ago. And since then it declined to the current 1.8. I'll start with an overview of the company, check the fundamentals, check the future prospects in order to see whether this is a real bargain or not. Company overview. The company aspires to produce 1.5 million ounces of gold at all sustaining costs of $950 per ounce within 3 years. $950 per ounce of mining costs are still relatively high, as many miners have costs below $700 and provide a larger margin of safety. For now, the company is producing 1.08 million ounces of gold from 12 mines in South Africa and 1 mine in Papua New Guinea. In total, it has 38 million ounces in reserves and 107 million ounces in resources. If gold prices go up, those resources have the potential to become reserves. Thus, if that happens, if gold prices go up, Harmony has the potential to produce gold at 1.5 million ounces per year for the next 70 years. Thus, we are really looking at a multi-generational investment. Of all the reserves, 58% is in Papua New Guinea, while the rest is still in South Africa. Most of the mines currently operating are in South Africa, and South Africa is known for high grades but extremely deep underground mining. When you mine underground, there is always trouble coming from accidents. And mining in Africa is highly labor intensive, with cheap labor, where a lot of accidents happen. Even if Harmony managed to lower the injury rate, the company has 30,457 employees and the injury rate is still around 8 per 1 million hours worked. A quick calculations leads me to the conclusion that 1 million hours are worked every 4 days with 30,000 employees. Thus, there are 2 reported injuries that happen every day. If you Google fatalities and Harmony, then you will see what I'm talking about. Someone who does not accept fatalities should not invest in Harmony, as unfortunately it's not such a safe environment to work in. A look at the fundamentals and current production costs. Current production costs are $1,000 per ounce, which are relatively high. And that's also the main risk for Harmony. If gold prices fall, Harmony's profits, cash flows get wiped out, and then I don't think the company will go bankrupt, but no profitability, stock prices usually get hammered when there is no profitability. So if you invest in Harmony, you have to expect a lot of volatility. Higher mining costs mean higher volatility, much higher upside if gold prices go up, because then the margin improve exponentially, but also much larger downside if gold prices fall. However, as the company has almost no debt, it can weather even a longer period with lower gold prices, because it can sell some assets or it can shut down some mines to at least lower costs. What's also important for fundamentals is that operating cash flow was 321 million in the last 12 months, thus 70 cents per share. 70 cents per share is a lot when the stock price is just $1.8. The total book value is $5.1, but given the issues in South Africa, fatalities, a new mining charter that requires 30% ownership by South Africans, so that's an issue. The rand, the South African rand getting stronger is not good for Harmony, getting weaker is good because of the mining costs. So there is a huge discount. We'll see how it works out from the political and currency perspective. A look in the future will tell us what we can expect from the stock price, from the company and from the investment in general. Given the issues in South Africa, higher electricity prices, strikes, accidents, mining costs for the current year are expected to be at $1,100. Thus, margins will be a little bit smaller and the profit will also be a little bit smaller. However, Harmony expects in a few years to produce at $950 per ounce and to produce 1.5 million ounces, thus almost 50% more than it is producing now. For the more distant future, Harmony has a very interesting project in Papua New Guinea, the wafi-golpu project, 50% owned by Harmony, has an operating mine in Papua New Guinea, the Hidden Valley, with costs of $1,200 per ounce, thus not profitable at current gold prices, but with huge potential and hopefully lower costs in the future. And there is another discovery, the Kiliteke discovery, but I wouldn't consider that as significant because the lower copper grades of 0.5% per ton and only 0.5 gold grams per ton. Such grades are only profitable if copper and gold prices increase. But it is a good investment for the long-term future, as it is there and it won't go away. Golpu project is a very interesting project. It has one of the highest copper grades in the world. It's a very large deposit, and it's both a copper-gold deposit. Thus, as copper prices are expected to go up, but this is a topic for another video, and gold prices will probably go up with all the quantitative easing, is a great thing to own in your portfolio. As said, Harmony owns 50% of the project. The net present value is 1.8 billion at current prices. Thus 0.9 billion for Harmony. That would be around $2 per share, just for the Golpu project. The profitable mines in Africa are then free if you buy now at $1.8. In addition, on the Golpu project, the government has the option to buy 30% of the project for 235 million. 235 million for 30% equals 700 million for the whole project. Split that in two, that's about $0.8 per share. So to conclude, we have the Golpu project that, let's say, it's valued at 0.8 per share. Then we have a company that, without the Golpu, expects to produce 1.5 million ounces per year at an all-sustaining cost of 950, let's say 1,000. And if that happens and gold prices remain as they are now, we are looking at earnings of around $0.6 per share in 2019. So we have already 0.8 of value for Golpu, plus $0.6 per share in 2019. I'm already in $1.4, and the price is just 1.8. If gold prices increase by 100, that would add $0.23 in per share earnings in 2019. Attach a price earnings ratio of 10 to that, and you'll be adding $2.3 to the stock price per every $100. Thus, gold at, let's say, 1650 would have harmony above $10 per share. To conclude, we have no debt, current positive cash flows, potential of 50% growth, a huge valuable project, copper gold project, at a very cheap price. Book value $5, stock price $1.8, golpu project golpu project $0.8 per share, 2019 earnings and future earnings $0.6 per share. At current gold prices, higher gold prices would just magnify that. So I think the maximum you can lose is $1 per share, 0.80 cents potentially if gold prices decline. However, if gold prices go up, you can make $10, $15 per share. That's the kind of risk-reward ratios I like. Thank you for watching. Please leave your comments below. Click like if you like the content, and consider subscribing for many more videos about investments, stock analysis, and sector analysis.